Hey everybody, happy April Fool's Day, and thank you for joining me for another edition of Magna Libra Trading and Research. Today's episode is number 25 and entitled Liberation Day is Near as Trump Enacts Pro-American Tariffs. As always, quick disclaimer, following podcast is for educational purposes only. This is not a solicitation to buy or sell commodity futures or options. Risk of trading securities, futures, and options can be substantial and may not be appropriate for all listeners. All right, guys, hope you're having a good start to your day so far. And as you know, the world's awaiting in intense fervor as April 2nd is almost upon us. And as President Trump has stated, this is the beginning of Liberation Day in America. We're going to charge countries for doing business in our country and taking our jobs, taking our wealth, taking a lot of things that they've been taking over the years. They've taken so much out of our country, friend and foe. And frankly, friend has been oftentimes much worse than foe. This was Trump from an NBC News interview. President Trump's looking to put 20% to 25% tariffs on a lot of imported goods from countries like China, Canada, and Mexico, and will penalize countries that continue to import oil from Venezuela. It'll be interesting to see how these countries respond. My guess is President Trump is already many moves ahead and that he will force these countries to do what America wants them to do. The rhetoric around mainstream media is that this will raise the cost for all Americans, that this will hit GDP hard, and there will be forces already at play that are doing this already, guys. So we don't think that the tariffs are going to add to this already of what's transpiring across the global economies anyway, from years and years of overspending, overcapacity, and false economic signaling that's enabled from an ever expanding global central banking system, which never solves any problems, but rather masks them with continued asset expansion. And we're going to put a chart up here to show that here. And those days seem to be over for now of that overexpansion, as you can see from this chart, as interest rates have remained high, and the FOMC, albeit slowing their pace of quantitative tightening, has now seen their balance sheet shrink to 6.7 trillion, its lowest level since May of 2020. So if you take a look at this chart here, this is where we're at right now, 6.7 trillion, and this is where the FOMC asset base was back, we highlighted here May 6, 2020. So we've come all the way down from just right under $9 trillion there down to 6.7 trillion. So this is what's known as quantitative tightening. So the asset base at the FOMC has tumbled down to May 2020 levels. For those that don't know how important it is to have a central bank that prints money to buy assets, know that nominal asset prices are driven by this mechanism. You will hear many deny that this is indeed the case, but take it from us. We've studied and followed this for over 2 decades. The only reason they need to expand their above their 2% growth mandates is the game gets exponentially more and more expensive, meaning in order to keep the same level of nominal asset price value, whether it be stocks or real estate or whatever, there needs to be a base layer of money to be levered up from, and this FOMC asset is that base. The global central banks provide this base layer, not just the FOMC, but the global central banks in general that all follow the same mechanism. Fractional reserve banking allows money creation through lending, where each dollar in reserve supports a multiple in loans, traditionally up to 10 to 1, depending on reserve requirements. And considering there aren't any reserve requirements anymore, we'll keep it at 10 to 1, I guess. However, this process is reversible. If deposits are withdrawn, banks must contract lending proportionally or sell assets to maintain liquidity. When credit growth stalls, whether due to falling demand, defaults, or deleveraging, the money supply shrinks. This contraction reduces demand for assets, leading to declining nominal prices and a potential financial instability as this leverage unwinds. This systemic fragility is inherent risk of fractional reserve systems. And let's just take a look here, and you can see here from this chart, I believe this is what we're starting to see here. And honestly, nobody even talks about this mechanism except us here at MTR, of course. You see here that the FOMC has everyone fooled, thinking that their inflation mandate is 2%. Well, it hasn't been 2% for forever, or at least the last 30 years. As you can see from this chart here, that we've longtime listeners and readers have seen us post this chart before, that annualized the inflation rate's actually 2.99%. So it's actually been 3%. And if it's been annualized at 3% for the last 30 years, guys, we're pretty sure that the FOMC is comfortable with that 3% level, even though they say they're not. So even worse, if you take a look at the other side of this chart, you'll see that the FOMC themselves have expanded their asset base by a staggering 9.79% annualized over the same time period. So what the FOMC or Federal Reserve has done, especially post-COVID, is that it continues to shackle the average consumer with this high inflation, while simultaneously enriching the very upper echelon, who, for all intents and purposes, have no place for all this excess liquidity. In fact, we're going to put up this next chart here from Moody's Analytics, and posted from my friend James Eagle on Eagle Eye on his Substack. And if anyone wants a free month of his work, I suggest you take me up on this offer. Either email or go in the direct chat and send me your email. I've got 3 of these gifts to give out, so we suggest you guys take a look at it and take advantage of this if you want. Hit me up on chat or email, and you can get access to James' great work there on his Substack. Anyways, this is the problem with fiscal and monetary stimulus. For the bottom 90%, it's transitory. So if you take a look at the post-COVID big ramp up in fiscal and monetary stimulus, it's for the bottom 90%, they spend it and it gets diffused over a very short period of time till it's eventually fully liquidated. As this chart points out, the bottom 90% have liquidated about 809 billion from the peak in Q3 2021. Now contrast that with the excess savings of 1.3 trillion to the top 10%. Less than 100 billion of this has been liquidated from the peak. Basically, all of it's been retained, saved, or parked in risk assets, real estate or equity or some other money market or other vehicle. I don't know about you guys, but all this stimulus seems to do is increase the cost of living for the bottom 90%. So you can see that chart here, and this is the stimulus post-COVID. This is the excess savings, and here's the bottom 90%. You can see how it's being spent out and dispersed and throughout the economy and not retained as savings. And whereas you look at the flip side of the top 10% of earners, you can see that it doesn't ever really fall that much, 100 billion compared to 809 billion. So the trajectory is obviously, everyone else at the bottom 90%, they spend it all in the real economy. And by that time, over the course of a couple of years, it's basically fully liquidated and gone, whereas the top 10% retain it. So that's kind of one of the things that this chart's pointing out. And even now, though, it seems that the upper income is starting to show signs of pulling in the reins. And we've got another chart here from Danielle DiMartino Booth that she shared on her writings as well, the Daily Feather. And so we want to give her credit there, even though it's from the University of Michigan. This chart is showing expectations collapsing to decadal lows, and this is for the upper income consumer expectations. So we can see the drop here, multi-decadal lows here. So even at the upper echelon, the sentiment isn't that great. And Statista is also confirming this via the overall consumer confidence in the monthly data chart, which we have over here now as well. So, consumer confidence, it's falling, and this is not the kind of picture you want to see going forward here. Things have gotten too far out of line, too expensive, interest rates are too high, and we believe that the economy is making a turn for the worst, and that's also why we believe that the equity markets have topped out here. So kind of tying this all together, this is kind of where, just adding to our fundamental economic thesis here that we're going to see a slowdown, and we are still awaiting that negative non-farm payroll report, and then that will usher in an even more panicky FOMC, who would no doubt under pressure to lower rates from the Trump administration. All right, guys, before we get to the technical charts, look at, and that's the stuff that we look at on a daily basis that MTR subscribers get. This is for the guys that aren't joined or subscribed yet, that maybe you're going through our free version. You guys will get access to our daily data and our trackers and our Magna Lever Commodity Trading Advisor Market Sentiments Tracker, which gives you the insight to the overall market trends for all the sectors that we cover. And this will give you a greater understanding of monetary flows moving across the various market sectors, covering bonds, equities, currency, energy, and metals. So if you guys haven't subscribed yet, or if you're a free subscriber, we suggest that you become a member so that you can get access to these data trackers that we put out. And the goal, guys, is to educate you to make you a smarter trader and investor, and ultimately creating a mindset for you guys to improve all facets of not only your investing and trading, but in your life in general. So, even though this one, we try to put out a lot of free content, but obviously have to put some stuff behind the paywalls, and generally our videos are mostly free. So hopefully this will shed some light on what you can expect from MTR on a daily basis if you're not a current subscriber yet, and hopefully this video will give you enough ammo to make that decision. So we know we present things drastically different than a lot of other venues out there, so if you can't afford to subscribe, then please just share our work then, and we'd greatly appreciate it. All right, let's move on to some of the technical charts here. in regards to what we're kind of looking at right now. And this is the S&P 500 futures. We're going to kind of treat our yellow lines here as the bull and bear pivot lines. And this is on a 4-hour chart here on the E-mini SP 500. Our blue lines will be our longer term support with our red lines up here, resistance areas. So generally, this is more of like a longer term area, buys and sells. We generally like to look as commodity trading advisors, like to look on a little bit more longer term time frame, but we've got a lot of people that most likely probably trade intraday, micro minute stuff even. And but we always got to stay cognizant of the bigger picture. Now for us, for the E-mini SP 500, this 5675 level seems pretty important for us. It'll be a first initial resistance as we get back up here if it trades up here, and we would expect sellers there to battle it out with the buyers. But if we can get above there, then the buyers will gain control, and then the risk will be back up to this 58.72. But if we stick around here and this becomes a magnet, then we have to wait for either confirmation of a weekly close above or below it to kind of go with. For right now, the sellers are still in control. We're just working off some oversold conditions, as we did, here from the bounce off the lows. So right now we're kind of more in a neutral status here with the S&P 500. We know it's in a consolidative mode here. We don't think the downward trend that's been in place since actually falling late February, through the middle of March, and then we got to bounce and then fall again. We would expect that the buyers and sellers are going to battle it out here, but the overall trend is still down. But unless we get above 56.75, we don't think the bulls will get much momentum here until we can get a push above there. So 56.75 is the number the bulls should be targeting here. So keep an eye on that level in the SP 500. As far as the NASDAQ futures, we liked this 19,150 area. We can see that the buyers came in once again. And so this is it's kind of bullish for the Nasdaq to keep pushing here. Ultimately, 20,215 is once again a bigger target for the bulls to kind of regain the bottom here and push the market higher. But we're quite a ways away from that. So there's a lot of work to be done here for the bulls, but ultimately the sellers could be under pressure all the way up to this level. So you're talking about another 500 or so points from here, 500 to 600 points that the bulls would need to pressure the shorts here to get any kind of a real bottoming formation. But once again, the trend is still down until we take out this level here, 20,215. So we'd expect pops to kind of slowly, march their way up, staircase step it up, and then we'll probably see some quick selling back and down. But this is the area between 19,150 and 20,215 where we can expect a consolidation battle to ensue between the bears and the bulls. So keep an eye on those levels there. Unless we get above or below those, the sellers need to push back below 19,150, get this momentum back down. And the bulls really need to kind of get us back above 20,215 to get our momentum to swing back upwards. But we're much closer to the bottom here on this side here. So no doubt you longer term value players can step in here with their stops below this 19,150 most likely. Moving over to the 10-year, then the bonds, we did obviously respect that 4.37% level. You guys have known we talked about that level for some time, so we're backing off there in regards to the 10-year yields. Now remember, guys, when yields fall, the prices rise. So this is bonds moving higher in price and the yields falling, and we're back into this downward trend channel. So can we stay in here? We'll see. 4.25% for this week seems pretty important. So we'll see if we can stay below in the 10-year, below 4.25%, and then the bulls in the bond market there will stay in control there. Another chart that we're kind of looking at here is the euro currency. This one's trying to put in a decent bottom. We've liked this big move here early on this year, and then the response back up. Right now we're moving up to that 109.5 area. If we can get up there and above there, ultimately this 110.28 area in the futures is key. We'd like to see if we get above here, guys, and the bulls are going to be in control, and we can really run. Because this is, you had a lot of consolidation here over 2024 in between 107 and 110. And now if the euro can push higher here above this 110 level, then we most likely are going to start to see some real good buying momentum in the euro, which would lead to a weaker dollar. Most likely is what we're going to start to see. So 110.28 seems to be our level to still here in the euro. Like to see the bulls get it back above there. If not, obviously we're still kind of like trying to beat around this long-term trend line path here as a magnet. So 109.60 to 110.28 is really the area where the bulls need to get above to order to gain some real momentum to the upside. Moving over to crude, this one looks bullish too. A nice bottom there down at the 65 buck area. We're above the bull bear pivot here at 68.32, and now we're moving into that first resistance area, 71.50. Breakout above here. Obviously, the bulls are still in control here, so unless we get back below 68.32, we wouldn't be short crude oil here. And especially with everything going on, tariffs and everything else going on, we would suspect that unless we get back below 68 bucks, the bulls are going to be in control here for crude oil. Moving over to gold, this breakout above our long-term trend channel area is a nice solid breakout. We would suspect a move back to test some of these of this breakout here, not just a straight up move up here. Obviously, we're in no man's land. We don't know how far gold can run, but you're going to get guys that are going to sell this into this every single time and then just get stopped out and gold's going to keep running. But realistically, this is a bull move here. But we'd like to see a little fill back in here around 30.75 area to retest some of these newfound longs to see if we start to get some momentum to roll over and get us back into this trend channel, or if we end up, continuing to run and the stops just keep getting hit and people just start, now we're going to go back, recycle back up, maybe get to 3,500. But we'd like to see a little back and fill here. This one-way pop out of here just seems a little bit forced. So we wouldn't be shocked at a move back down in gold to get us back into the 3050 to 3,100 area for a little more consolidation on this ride up. But gold is obviously bullish here. In regards to the settlements for the end of March here, we've got the settlement page. This is what you guys, if you were subscribers, you would get every single day. It shows the various markets that we cover, interest rates, the U.S. Treasury actual cash market, the yield curves of the bond market, equities, Bitcoin is here, currencies, energy, metals, and then the German futures in regards to the boons and the DAX markets there. So we could see that there was decent move here, holding in the equities yesterday at the quarterly end here. They held up. Bonds also, front end was a little bit weaker, longer end stronger here, which is indicative of here. All the energies were stronger into month and quarterly end. And it looks like the energies were a little bit, or the gold was stronger with the silver and copper both lower into quarter end. So these are the kind of things that you'll get on a daily basis as a subscriber that are available to you. You can take a look at our data, structure your own data in whatever ways you want, and then we kind of keep a rolling change of the 5 and 30-day net changes here. And we consolidate them here in this quarterly chart here, showing you the winners and losers, which Nat Gas was the big Q1 winner, up 29% basically there. Rounded out the top three with copper and silver, and gold was right here too, right up at 17%. So I think it was like 16.9%. So nat gas, copper, silver, and gold were your big winners Q1 so far. Big losers: Bitcoin, Russell 2000, and the Nasdaq here. So we'll see if this momentum, changes for Q2 or not. But obviously, we like to keep track of all this data, and this is kind of more of a global macro picture of the commodities that we cover. So you'll get things like this on a daily basis, and you'll also get our CTA market sentiment, which the only change yesterday was the Japanese yen moving to a neutral status. This is our CTA Commodity Trading Advisor market sentiment, kind of gives us a kind of a good picture of where we think the flows are in regards to the various sectors that we follow. Like we said, bonds, equities, FX, energies, and metals. And we'd like to take a look at these as a whole, not the individual aspects of a long one, short one, or neutral, which is kind of how we just keep this very simple. Right now, basically the fixed income is neutral. Equities are leaning a little bit short, but not much here. They're basically all neutral as well after this bottoming out move. So the flows there seem neutral. FX is bullish here, which is dollar weaker, and energies and metals are obviously in a bullish sentiment. Buying flows much better seen there. So that's why we try to keep track of this. This is updated daily as well for our subscribers, so it's a good way to kind of keep track of the global macro picture of the markets that we do cover. In regards to another thing our subscribers receive, it's the Mega 8s. We started following this in May 23, as we know that AI was filtering all the capital investment into these top 8 stocks. We switch out the bottom, the 8. We actually keep track of 9. We keep track of Tesla's in here too, but between Tesla and Broadcom, they kick each other out. of the top spot. And actually, right now, Tesla's market cap's higher than Broadcom, but they keep flip-flopping, and we've kept Broadcom in here. But most likely this week, if they still stay below Tesla, we'll probably re-add Tesla to this Mega 8s. But you can see that the Mega 8s are, 7 out of the 8 components are lower. Obviously, Berkshire, we've talked about Berkshire for a while as a defensive play because of all the cash that they have. So obviously they've performed really well so far year to date, while everyone else is lower. When you got 335 billion, that's no surprise. There's money that they have set aside, and Buffett's one of the best ever, so we know he's not looking at value here now. So, but not much change in the overall in the Mega 8s yesterday. Very, very marginally lower. You know, nothing really changed there. And for this week, we're going to look. Another thing we try to do with this long only basket for educational purposes only, obviously, we try to give you an idea of like kind of how to hedge something like this, and you can always base it percentage wise on your portfolio. Maybe you want to hedge a 0.5% to up to 2% of the total portfolio, and you can do so with these options. So you can, if you're long all these, obviously your big exposure is to the downside. So we always look to like sell calls against a big long only basket like this. And for this week, we're going to target the 483 calls at $3 or better. So we're probably gonna need a move in the triple Qs above 475 to get this off. So we'll see if they do, but you guys don't want to chase hedges. If you get them off, you get them off. If you don't, well, then you just kind of let it roll. But it's not something we like to chase. If the market comes to us, then we put it on. But this is the Mega 8s is what we call it. Here's the market cap total for this group. Probably down about 15% off the highs here. So this is total market cap near 16 trillion. So we keep track of this data as well. And it's important to note that they're still well below the 200 period moving average. So that's obviously a bearish indicator, not bullish. And then we look at the Mega 8s, and this one does have Tesla in it, not AVGO, but it's been in a downtrend for the start of 2025. And we're going to keep this downtrend intact here as long, and we're coming to a big number here actually. And this is kind of a balancing number for the Mega 8s. Obviously, the bulls would like to get it above here, and then we could trade back up to the top of this trend channel line. But ultimately, we think we're targeting down here somewhere at 18, 19 over the course of 2025. So unless we break out of this, guys, the mega caps are going to lose out to the rest of the S&P 500, let's say, due to diversification, and which isn't surprising if you look at this run from 2023 to 2025. It's massive. So up like 2.8x. So pretty good move here. So no surprise at the fallback here. Another thing that our subscribers get, we've kept track of a strategy B, which is their symbol is MSTR. This is the Bitcoin company that basically what they do is they issue convertible bonds and issue debt to buy Bitcoin. So they're basically swapping dollar assets for Bitcoin. And the biggest thing that they sell is actually volatility, because they know they need volatility in order to entice the participants to buy their 0% convertible bonds. So this is something that we've felt is important to keep track of, since we are big fans of Bitcoin and decentralization. But once Wall Street has gotten heavily involved here, it's kind of hijacked the real, kind of core thesis behind a decentralized, immutable, ledger-based peer-to-peer system. But this what MicroStrategy is doing does make sense. The only thing is, they need a constant influx of buyers, or else they're going to risk the price of Bitcoin falling. And every time they buy on new highs, then they're just raising their dollar cost average price. So, but for now, we like to look at this stock as a long only. Like if you guys bought MicroStrategy, and then you could sell the call against it to kind of see what kind of your return would be. And that's kind of what this, we've kept track of this since December 1st, 2024. So you're down actually a little bit of money if you're just selling kind of near like an 8 or 10% out of the money call. And we kind of show you guys which call every week is listed here that you should be short. If you were long these, shares. So it's a covered call strategy. It's a not outright risk, which would be an outright risk if you were short naked and not having any of the underlying on. But this is a covered call strategy. Then we also keep track of the volatility, which quarter over quarter, it's down to about 24%. So that's not good for MicroStrategy either, because we know they need increased volatility to entice everybody here into this thing. But when we look at MicroStrategy, they just added, I think, about 28,000 or so more Bitcoin yesterday. But their dollar cost average price is now up to 67,458, and their premium over their equity premium over the Bitcoin itself is about 1.8x. And this is what all the big hedge funds are about here, this 1.8x premium. So you'll get the hedge funds shorting this equity here to try and drive this down to the intrinsic Bitcoin nominal at value versus the equity itself. But yeah, will they be successful? I don't know. Maybe, maybe not. Um, but we like to keep track of all this data because we think it matters. So we're not going to give you guys anything that we don't think doesn't matter, only things that we think are pertinent to kind of ongoing things that are kind of being talked about in mainstream media, but not maybe talked about in the right manner. So hopefully give you a better idea of this kind of stuff and moving forward and what you can kind of keep an eye on. In regards of strategy B in the stock, 315 is their big number on the upside, 270 is the number on the downside here in regards to their Fibonacci support, but ultimately 231 is the big number. We get below here, then we're probably going to go recycle back down to full new lows. But 231 is the big number on the downside with 316 on the upside. So we might get some trade back and forth in between here. But ultimately, we would only look for a breakout above 316 and a bust out below 231 or so. So keep an eye on that, guys. That's one that hasn't been on your radar. Keep an eye on these guys because it's one of those pure Bitcoin plays that mainstream media is going to talk about, but we go a little bit more in depth here. And then finally, just going to leave you with this, guys. We're kind of looking at trying to give Gemini the benefit of the doubt in regards to not being biased. But when we put this, we just try to create an image that is pro-American, pro-Trump, pro-US dollar, pro-military, and usher in the golden age of America, and it wouldn't give us a picture. So we thought that was weird. Kind of like, it's just pretty simple. Just kind of, you create a meme if you want, but it said no. It may go against our guidelines. And then we said, okay, let's create an image that hates America, hates Trump, hates the U.S. dollar, hates the military, and ushers in the dark ages of America. And of course, it gives us a dystopian picture. So this is the kind of things that annoy the crap out of us because we know this bias exists. We know everything in AI has changed when Sam Altman went in front of Congress. They really did a number and started to really like crack down on kind of the freedom that the AI had to generate stuff. And this is just one of those obvious things that we like to point out. There's nothing to do with being left or right or Republican, Democrat, just a simple bias that we can't stand that exists in AI. And it's one of the reasons why, in America, that if we don't get rid of this kind of bias inherently, that companies like DeepSeek are going to take over because they don't have this same thing. So that's kind of what we're up against, and hopefully this kind of sheds some light that it's not, conspiracy theory, that there is inherent bias in these things. And once again, AI is just as good as the input that's going in on the creator side of whoever's engineering that AI and what they're allowed to say or construct. So wanted to point that out, and as always, stay positive, guys. We'll try to keep you well informed and keep everything at your fingertips, moving in the right direction. And remember that you have to. We live in this world where you have to stack the probabilities of your success in your favor. So take those little steps, get to where you want to be, and every little stumbling block that you overcome does indeed matter. So good luck out there, guys. Until next time, cheers.